Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening to all the viewers of Looking for Your Good Night. I'm your average analyst, Shu-Ren Chung. Tonight, the non-farm payroll data will be released at 9:30, so we'll probably be talking until about halfway through. When it hits 9:30, we'll cut away to check out the non-farm payroll numbers and see how the market is reacting in real time. So later on, we'll make a special point to switch over and take a look at that. Today, what we mainly want to talk about with everyone is, well, when we get to the second major sector, which is energy, just which energy stocks are important. And here, we really want to get into whether it's all about geopolitics, because right now, everyone is probably seeing that. For example, Iran might be involved. Like yesterday, Trump said again that he might consider sending a second aircraft carrier to deal with Iran. So is this real or fake? Will it actually happen? And how will the oil price react? Honestly, we don't know right now. But the issue now is, when it comes to energy stocks, should we be looking at geopolitics or the core structure? Let me give a straightforward conclusion first. I think it's the core structure that's changing. I'll talk more about why I believe the core structure is shifting. Actually, there are a few reasons. For example, there are two investment banks and one pretty famous figure, someone who's really well known in the energy or especially the commodities market. He actually made some relevant comments and did some related research. I really agree with his views, so I wanted to share them with everyone here. Basically, I also think this is relevant for this year, 2026, the year of the golden horse. Wait, no, this year isn't the year of the golden horse. It's the year of the living horse, the red hair living horse year. Given the situation this year, what exactly will make everyone truly shine, boost performance, and bring in abundant profits? This is actually a very important question. I'll be sharing some of my personal views for your reference. And then, yesterday, there was something rather important. Two officials made some statements, so today's data actually becomes extremely important. Alright, first, let me talk about a few relatively new pieces of news that were just released. The first is about Israel. Netanyahu has gone to the US again to meet with Trump because he's worried that Trump might sign a small-scale nuclear deal with Iran. But the problem now is that what Iran wants and what Israel wants are completely impossible to match. So if the US supports Israel, Iran is definitely going to be unhappy. So is it possible that in the end the US and Iran will end up in conflict? That might be something coming up next. I can even just say it directly. What should we really be paying attention to during the upcoming New Year period? It's this issue, because if, due to the latest pizza index, which is actually soaring again in the US, and all the big players are now working overtime, everyone is working overtime, so whether a real conflict will break out, we might find out during our New Year holiday. Alright, and if a real conflict does break out, I have to say, I'm not sure whether it will impact our Taiwan stock market, but it will definitely have a major impact on oil prices, so this is definitely something everyone should pay special attention to. And then there's also Adobe. They're still continuing to invest in the most relevant AI projects, and their latest investment target is this company called Astropic. This is also the AI-related company that's recently caused software stocks to take a hit. Alright, and I am really sorry about that. Then at 9:30, we'll have the non-farm payroll data, followed by the unemployment rate, and at the same time, there will also be revisions to last year's data. That's actually pretty significant. Currently, the market expects 825,000 jobs, but in a bit, I'll go over Brembo's own forecast and their situation with everyone. Then, a bit later at 11 o'clock, there will be the shift, and after that, at 11:15, Boomer will be speaking. Before we get into the two main topics for today, I want to share this piece of news with everyone. I saw this news today, and I think it's something everyone should pay special attention to. Because as I've illustrated here at the mic, the market is no longer focused on looking for potential winners, but is more about avoiding those companies that might be replaced or are at risk during times of change. Honestly, that's the situation right now. It's still uncertain who the winners and losers will be, or whether the entire industry structure will undergo a major shift. For example, take the latest AI-related service announced by Lijuan. Can it really, truly, 100% replace all these traditional Lijuan software solutions? Can it really fully replace the services currently being provided? We're not sure yet. Or is it just more of a powerful assistive tool for people working in the Lijuan field? Honestly, none of this is certain right now. But at the moment, the market is really being driven by valuations that are just too high. The volatility is just too high, so even the smallest flaw, risk, or bit of negative news causes the market to react extremely strongly. That's why I'm saying there's been a major shift in market thinking, because right now, basically in the AI sector, aside from what I mentioned to everyone the year before last, that in AI, the stronger the industrial application, the safer it is. So in the entire AI sector, which area has the strongest industrial application? That would be our own, Taiwan's TSMC. So did y'all notice how TSMC closed today? It was really strong, closing at its highest, a beautiful performance. It looks like after the new year, it might be gearing up for some big moves as well. Actually, this is really because right now, if the market wants to get into AI, the stronger your industrial fundamentals are, the more solid and stable your fundamentals, the more likely you are to see future gains and development. That's why people have more confidence in it. So this is just how the market works now. I'm using this news to show everyone what has the market mindset shifted to. A means safety. So now people are no longer chasing high beta or high momentum. What is everyone after now? They're looking for what gives them a sense of security. So the companies that can provide the most security are the ones that in the coming months, people will be more willing to invest in. As long as they're related to AI, that's great. Even if a company isn't related to AI, as long as it can provide a strong sense of security, it will still be a direction favored by market capital. And here, let me show you. I've compiled the price to book ratios, PB, for the 4 major indices. Since we're talking about a sense of security, you basically need to look at PB from a static perspective. This one here is the NASDAQ. The NASDAQ's PB is about 8.6, currently around 8.6. The S&P 500 is about 5.5, the Dow Jones is 6, and the Russell 2000 is 2.4. Now, if you look at the white line represents their overall stock price chart. Did you notice something? It's especially weak. The NASDAQ is particularly weak because its PB is relatively high. So in terms of overall safety, since PB itself is considered a measure of safety, it's actually the most expensive one. For PV, it's the most expensive. So the difficulty of hitting new highs is greater than for the S&P 500, Dow, or Russell 2000. That's why we've said to watch the Russell or the Dow this week. And if those still do not work, at the very least, you should be trading the S&P 500. The reason is because from a market mindset perspective, when this kind of safety-oriented thinking appears, it does not necessarily mean they are only buying value stocks. Rather, what they prefer is, hey, is buying this way safer for their company? Is it relatively safer for their entire portfolio? These kinds of companies already have a strong enough moat, or their moat is secure enough that it won't be completely wiped out just because of some so-called AI breakthrough or technological disruption. If that kind of thing isn't going to happen, then actually these companies are quite interesting. Often, their PB ratios are also relatively low. In some cases, they're actually quite high, because to some extent, these companies are asset-heavy. Asset-heavy companies are also typically companies with strong cash flow, so these kinds of companies are likely to be a direction that people will pay special attention to in the future. So this is also why I say that the NASDAQ 100 itself, or the NASDAQ Composite Index, or the NASDAQ 100, actually carries relatively higher risk compared to several other indices. And that's also why Europe has been able to keep hitting new highs. Why is Japan also able to keep reaching new highs? Because they are also DPB. Europe is not just DPE, it's also DPB. So in terms of valuation, Europe is truly relatively low, and Japan is DPB. Compared to the US, DPB means its net value is relatively low. So it's all based on a similar logic. All right, let's move on to the part about Fed officials. Yesterday, Logan directly said that only real weakness in the labor market would support a rate cut. That's why I said today's data, well, I labeled it as a key piece of data. The reason is that if today's data and the revisions together show real weakness, then this official, Logan, might consider supporting a rate cut in March. So in a way, today's data actually becomes very important. Also, since he has voting rights this year, his statements carry a lot of weight. Right now, their assessment is that overall hiring is balanced, so at the moment, everything looks stable in terms of employment. In other words, there hasn't been a rapid decline in jobs. And then the European Union is also not very certain. So since things are stable, but inflation is still uncertain, they tend to prefer keeping interest rates unchanged. Actually, Hammock has a similar logic. He also supports maintaining the current interest rate level for a longer period of time. He feels that overall, the outlook is cautiously optimistic, and the overall employment situation actually isn't too bad. Unemployment might go up, but overall, it's still uncertain to what extent it might rise. The job market still looks pretty good, so there's really no need to rush into cutting interest rates. Only if the labor market cools down significantly further would it become appropriate to cut interest rates again. So whether it's Hammock or Logan, they're both really just watching the job market. If the job market truly weakens, like really takes a sharp downturn, then that's when they would consider making a move. Only at that point would they consider cutting rates. Alright, so this gets interesting. According to their own forecasts, in 2025, there will be a loss of 1 million jobs. And after March of last year, there have already been several months of negative growth, like several months in a row of negative growth. The reason is that the original model used by the Bureau of Labor Statistics has some issues. To put it more bluntly, the numbers from the BLS are probably all wrong. To be even more straightforward, their algorithm over at Brembo is basically all miscalculated. Starting from January this year, they'll be using a new model for their estimates because it will incorporate real-time data from surveys. So in other words, they won't be using the old method anymore. Let me put it this way. The original data was based on a bunch of assumptions. From the perspective of most people, these assumptions actually make sense statistically, so there's nothing wrong with them. But from a common sense point of view, it's all just made up. Basically, to the average person, it's all just made up. But from a statistical standpoint, it's reasonable and correct. But that's because they're looking at it from a statistical angle. Now they must consider synchronized data, incorporating real figures into calculations. This means there might be 20,000 fewer people on average each month, a truly astonishing drop. With this correction alone last year, there would be at least 660,000 fewer people. Then, with seasonal factors, that's another 300,000 fewer. Totaling it all up, that's nearly 1 million people. And then moving on, actually another reason, as you can see above, is why there might have been a significant downward revision last year. And then moving on, in fact, in the second half of last year, startups actually saw a reasonable rebound. So even if there's a downward revision in the future, it's still okay. It won't be, if there's a downward revision, it probably won't be like the initial announcement. Say if it was 30,000 people, it wouldn't be revised down to 10,000 or even to negative 10,000. If it starts at 30,000, at most it might be revised down to 25,000. So that kind of range. So basically, the data they give at the beginning tends to be closer to the real numbers. Plus, the BLS actually has a new director now, and that director is an old official, a very typical old school technocrat. He's becoming more and more Americanized, and he's also a highly specialized scholar in statistics. So it looks like with him at the helm, the BLS will be making adjustments one by one going forward, and these changes will actually better reflect the real situation. As for the impact on the overall market, it probably won't be something that happens all at once on the same day and then gets revised later. Those kinds of drastic changes, what Trump and his people would call faking the data, are unlikely to happen in this direction. So basically, the data going forward will likely be adjusted to reflect reality more accurately. In a way, this improvement is a good thing, but because there will be this gap in the middle, last year's data will probably be revised quite significantly. Oh, PP is the net value ratio, which, according to how we usually refer to it in Taiwan, is actually the price to book ratio. So everything I just mentioned is based on that. The Nasdaq has the highest price to book ratio, while the S&P 500 and the Russell 2000 both have relatively lower price to book ratios. Again, using the terminology we commonly use in Taiwan, that's the price to book ratio. Because the price to book ratio actually, from the perspective of a company's management, when these companies go through capital liquidation, the assets of these companies are roughly worth how many times their current stock price. In other words, it shows how many times the stock price is compared to the company's assets. That is, it's a multiple of the assets. As long as your price to book ratio is 1, it basically means you can be fully liquidated at that value. But if your ratio is higher than 1, it means, well, people have higher expectations for you, relatively speaking. The higher your price to book ratio, actually, relatively speaking, well, it means that for your company, your corresponding stock price, and all the related future expectations, people will expect your assets to keep growing. But the higher your price to book ratio, actually compared to others, you're just temporarily more expensive. So people's expectations for you will definitely be higher. That's also why it's believed that in the short term, it's relatively harder for the Nasdaq to hit new highs again compared to the Dow Jones, the S&P 500, or the Russell 2000. All right, and then according to the calculations from Bunburn, the job market may have already been in recession for a while, pretty much since after March. It's basically been in recession. However, after the end of last year, the overall survival rate of businesses actually improved. So even though it looks like the recession is pretty severe, the situation in 2026 probably won't be as dire as it seems. So basically, the worst of it is already over. It actually ended around last summer. That means looking ahead to 2026, the job market shouldn't be one that's collapsing dramatically because the time for a crash already happened last year. However, the market also didn't really react much to it, so it feels like the worst might really be behind us. But because of this whole downturn, actually, according to Brembo's analysis, the expectation is that this year, at the very least, things will drop by 40 cents. So if there really is a significant downturn and today's non-farm payroll data doesn't turn out to be particularly strong, then it's possible that the Fed officials might consider a rate cut that's even bigger than what the market is currently expecting. It could be even bigger, and there's a chance that before Powell steps down, there might be at least one more rate cut. That possibility is definitely there. All right, and I also want to apologize to everyone here because while I was organizing the materials today, I suddenly realized something. I left out industrial stocks. That day when I talked about inflation-sensitive stocks, I just lumped them together as industrials. But if you look at the S&P 500 sector ETFs, from that perspective, I really did miss out on industrial stocks. So this year, the four main trends are energy, raw materials, and then industrials and consumer staples, which are pretty much on par with each other, almost the same. So industrial stocks are definitely one of the major trends this year as well. I think on Friday, I'll probably talk to everyone about industrial stocks and the news related to those that are sensitive to inflation, or maybe on Thursday, depending on how things are going at that time. All right, so which companies are considered energy stocks? I'll leave this slide up a bit longer so everyone can take a screenshot and later check out which companies are included. Here, I've summarized the year-to-date performance, that is from January 2nd of this year up to yesterday, of the stocks that have performed better. Have you noticed anything? Basically, except for X bonds, all of them are going up. Everyone is rising, and the increases are not small at all. But the strongest performer is Texas Pacific Land. It's more like a land leasing company, kind of like a landlord. It mainly deals with land-related leasing rights, so it's a bit unique and different from traditional oil and gas companies. But take Schlumberger, for example. They sell drilling equipment and related devices, and then there's Halliburton, which does the same. As for Marathon Oil, after their spinoff, they're now focused solely on oil production. Oil transportation, and then ExxonMobil and Chevron, they cover the entire value chain, upstream, midstream, and downstream, including gas stations. They have it all. Then there's Halliburton, which, like Schlumberger, is also mainly focused on equipment. And the rest of these are also traditional, very well-known oil companies, but each of them is responsible for different segments. Some focus on upstream, some on midstream, and some on downstream. Only ExxonMobil and Chevron cover the entire chain, from upstream, midstream, downstream, all the way to retail. This is just for your reference. And when it comes to equipment, the most prominent ones are Schlumberger and Halliburton. Actually, for this part, I mainly used a report that Bernstein released a while ago. The market didn't really react much to it, but after reading it myself, I felt quite strongly about it. I think maybe it could be I think sharing this with everyone now is actually a pretty good and appropriate time. Low oil prices are often the best solution for low oil prices. What does that mean? Because oil prices are low, people tend to say, oh, that means the long-term outlook for oil and gas isn't good. But low oil prices often end up being the best solution for low oil prices themselves. What do I mean by that? Because when oil prices are too low, they'll eventually go back up. To put it simply, that's just how it is. When oil prices are low, they'll eventually rise. That's the logic. And if you look at the current situation, it's true. Everyone is pessimistic, whether it's oil companies or not. Or the main reason for oil prices, this is a fact, and there's nothing wrong with that. But the problem is, according to the overall industry structure, prices below $60 to $65 are a death sentence for the oil industry. What does the process of natural elimination mean? Because profits aren't high at these prices, some people will gradually go bankrupt on their own, some will slowly withdraw from the market, and some will simply stop investing, leading to a gradual natural decline. And in this process of natural decline, humanity will still ultimately need to use, well, let me put it this way. Have we humans really stopped using oil altogether? Even though we now have electric cars and all sorts of alternatives, is generating electricity really the only use oil has for humanity? No, the greatest use of oil for humanity is actually in the chemical industry, in the plastics industry, and in all the everyday products we use, not just simply gasoline. Gasoline is not the only contribution of the oil industry to human civilization. That's not the case. So even if all cars become electric, which even if that really happens, for us humans, our food, clothing, housing, and transportation, especially our clothes and all kinds of tools, including the computer we're looking at right now, or the clothes I'm wearing. As long as it's not made of pure wool, but contains some so-called various chemical materials, they're all part of the petrochemical industry. The clothes I'm wearing right now represent one thing. I haven't separated myself from the oil industry. So in the end, the oil industry is still one of the core parts of human civilization. In the long run, we humans still need it. So under these circumstances, as long as oil companies naturally transition over time, it basically means that eventually, since there's currently an oversupply, in the end, a balance will definitely emerge. A situation where demand exceeds supply will eventually happen, unless all of humanity switches to using only all-natural products, which is impossible, so in the end, we can't break away from the petrochemical industry. Also, at $60 to $65, returns are very low. In 2019, at $60, the return on capital was only 6%. In 2024, at $80, it's still just 11%. Now, looking at 2025 to 2026, even just last year, the average price was probably only around $60. I can't even get a return on capital. It's almost zero for funds. Plus, with all the rising labor costs and various other expenses, the return on capital is extremely, extremely low under these conditions. No one wants to invest. Nobody wants to make investments. So in this situation where nobody wants to invest in terms of long-term development, it means that there won't be enough capital investment in the future to support the amount of oil production needed to meet human demand. Because as humans, all of our economic development keeps moving forward, and our needs and desires continue to grow. Plus, countries in the global south, like Southeast Asia and Africa, are also starting to want to enjoy the fruits of human civilization that we now take for granted. So the demand for oil and petrochemicals isn't going to see a significant decline. That's actually a pretty crucial point. And then when it comes to oil stocks, they're not really reflecting the current price. They're more about the long-term expectations for oil prices, basically a discounted cash flow. Then, according to Bernstein, they estimate the cost to be around $71. So any oil stock investments with a break-even below $71 could potentially yield long-term returns. That's their own projection. Honestly, I think there's a good chance this statement is accurate because as long as you keep your long-term cost below $71 and you buy oil at that price, eventually the price will gradually rebound and return to that level. And once this rebound happens, basically the discounted cash flow here will slowly increase as well. As it gradually increases, the stock price will naturally be pushed up as well. So this is just for your reference. Also, OPEC's current spare capacity is at the historical average, just like Iran's, so the buffer space for geopolitical risks is extremely limited. Extremely limited, what does that mean? It means that if there's any serious geopolitical turmoil anywhere, there isn't enough extra capacity to cover it. There just isn't enough spare capacity. Plus, OPEC is basically acting indecisive, not really committed to increasing production. So it's possible that even if something happens with Iran, let's say hypothetically, if something really does happen with Iran, OPEC simply wouldn't be willing to ramp up production at all. They're not willing to increase production because at the moment there's an oversupply. Most places have more supply than demand. So why would they bother ramping up production right now? In the end, it could very well turn out like this. And then, according to a report I read earlier, the so-called inventories held by various countries right now, as for the severity of the situation, JP Morgan, based on their calculations, doesn't think it's quite as dramatic as people say. There may indeed be a lot of inventory, but it hasn't reached the point of being excessively oversupplied. It's not as extreme as people make it out to be. And then the investment rate among companies is extremely low, dropping from basically 100% down to 50% now. So in the future, if there's any need for reserve replacement, like if everyone needs to switch oil or stockpile even more oil or make any kind of adjustment, basically there just won't be enough capacity at all. So overall, production output could very well be affected. Yes, in fact, it could be a wake-up call, and there will be potential downward pressure. Also, currently, their estimated reserve lifespan has dropped from 10 to 15 years down to just 11 years. Why is that? Because there's been absolutely no capital investment, so they simply can't extract oil more efficiently. That's why the reserve lifespan dropped from 15 years to 11 years. It basically means that extracting oil from deeper and better reserves has become more difficult because they're not making any capital investments, so oil production is going to decline. At the same time, even though industrial demand in China seems weak right now, they've actually been stockpiling oil for strategic reserves over the long term. So in fact, they've been buying quite a lot, and it's expected that this year they'll buy even more than before. Then someone at the bank asked about the situation with shale oil. Actually, the top tier shale oil fields in the US are basically running out, and overall it's reached the zero inflection point, meaning there's no more growth. Growth is about to hit zero. Production is high, but not growing, so rig counts may keep dropping. If oil prices fall too low, shale operations there could completely halt. They might halt operations, but OPEC doesn't care, so the only ones hit are American oil producers, particularly shale oil companies. Alright, that was a report I just quoted from Bernstein. Now, another one is Rick Ross. He's actually quite a famous figure in the commodity sector. He's a pretty well-known heavyweight in this field, and he's most famous for what's called contrarian investing. He's really good at buying the dip. He's extremely famous for that, and he just came right out and said, a rare, epic opportunity is rising in oil and gas. Over recent years, these companies cut spending to pay dividends, returning value to shareholders. Consequently, a daily shortfall of $1 to $2 billion could occur, creating a likely future supply shortage. There's a real possibility of a supply shortage in the future. Right now, stock prices typically reflect an oil price of around $60. So if oil prices are estimated to reach $85 to $90, and let's not even go that far. Let's just use Brent's so-called marginal cost of $71 as our estimate. Right now, everyone's factoring in $60, but at 71, that's a 20% jump. This means the projected NPV return is at least 20%. So you'll gain from both dividends and price appreciation. That's why Rick Groh believes this is actually an epic opportunity in oil and gas stocks. Plus, most current analyses are based on the assumption that after 2022 or 2030, there won't be any additional demand. It's really possible that demand could actually decline. But as long as after 2030, there's no demand for oil anymore. Demand might not decline, it could even increase. This so-called fat tail or long tail fat tail possibility, once it expands, the value is also incredibly impressive. And right now, some of the well-known shale oil players, they know, have already stopped drilling. So to some extent, the possibility that shale oil will disrupt prices or overall production isn't very high. So in the long run, supply might actually be on the decline instead. And if demand turns out to be higher than everyone expects, then actually oil and gas stocks could present a long-term investment opportunity. So from a fundamental perspective, or according to these well-known experts, I'm just offering this viewpoint for your reference. This is actually why we think that, hey, instead of just looking at stock price performance alone, there's more to consider here. I think, fundamentally speaking, there really is a strong case for investing in oil and gas stocks. It's actually a very worthwhile opportunity to start making long-term investments now, and that's the reason behind it. There's really only one scenario that could break all this. If the global economy were to enter a Great Depression, which, as you know, hasn't happened, then the long-term opportunity for oil and gas stocks would basically disappear. That's when it would happen. So who should you invest in? You should invest in companies that continue to spend on capital expenditures and acquisitions. So which companies are those? Actually, if we're talking about Chevron and ExxonMobil, they're the ones that best fit these criteria. For example, in Chevron's latest financial report, they directly stated that their operating cash flow is basically growing by 35%, and overall, their projects are continuing to see very strong growth. Production is also increasing year over year, and they will keep investing capital, which is very important, continuing capital investment. So looking at their outlook for the future, the white line represents EPS and the overall revenue forecast for 2026, 2027, and 2028 are all expected to keep growing, so it's a continued upward trend. That means at least it's no longer in a declining pattern. As you can see, after 2022, it was actually in a downturn. It was declining. So basically, after this year, the next few years are expected to be more growth-oriented. So when looking at its stock price and its growth potential, you should view it from a growth perspective. The red line shows its investments, which are projected to rise. This aligns with Rick Rhodes' focus on firms investing in CapEx. It keeps investing, but what's interesting is that its cash flow is still growing. Its cash flow is still on the rise. So the reason why the market might be interested in it now, or is already interested, is because when you look at many AI companies, their problem is that their cash flow could drop to zero or even turn negative. But for these companies, their outlook is actually to keep growing. Fortunately, its current PE ratio is about 28, which is pretty reasonable, but its PB ratio is only 1.9, which is relatively low, a relatively low price-to-book ratio. So in terms of its book value, its price is quite reasonable. Compared to the mainstream AI or tech stocks right now, it's really low, because most mainstream AI stocks have much higher price-to-book ratios. They're all asset-like companies, so their price-to-book ratios are actually extremely high. Okay, it's 29 minutes in, so let's take a look at the next part. Let's look at the data section. All right, it was just announced, 4.3, the unemployment rate is 4.3, and the final number is, oh, non-farm payrolls are super strong, 130,000. Wow, non-farm payrolls at 130,000, so basically the expectation for a rate cut should increase significantly. So the US dollar strengthens, and as for US stocks, honestly, US stocks don't really react much to this right now, but the 10-year yield just goes straight up. The 10-year is basically, like we just said, Logan and Henman, they want to see a significant drop in employment rates. If the employment rate doesn't drop significantly and the job market is still hot, then basically they'll fully support not cutting rates at all. That's right, they'll go completely hawkish. The hawks might even push the doves to turn neutral, and the neutrals might turn hawkish, so basically, expectations for rate cuts will be completely overturned even further. But for the US stock market, it's actually not a completely bad thing. Well, for companies with high valuations, it might not be entirely good news, but for the overall market, it's really not all bad. Because it means the market is climbing higher and the fundamentals are strong, which is actually a good thing for most companies. But for those stocks that have already soared sky high, like, the ones with PEs of 100 or 200, it's not entirely a good thing. That's because they need lower interest rates to maintain their discounted cash flow calculations. But if that's not the case, then investors might not be willing to keep their money in those companies. So just something for everyone to keep in mind. Oh, I'll compare it with Huerta. I'll talk about it when I have time later, because this week we should still focus on finishing up those major sectors I mentioned first, and then we'll talk about that later. We'll talk about it later. As for software stocks, I have to say that's a bit. First, I have to say that in the short term, the market reaction is a bit exaggerated. It's just reacting. Like I said, the market's entire reaction right now is all about valuations. But has software really been completely replaced? For example, it's still too early to draw any firm conclusions right now. It really is a bit too early because you have to wait until it's actually being used in practice, when everyone really starts using it. When companies start to use it, let me give an example, just based on this news here. Let's take this news as an example. They launched this tax strategy tool, which led to, well, there's overlap with wealth management companies. Okay, so the key point now is if everyone really starts using these tax strategies, if they actually start putting them into use, is it actually good to use? Is it cost effective? Can it really save water? And is it really compliant with regulations? Can it actually be used in real world situations? That's the key point. So for this company, what's the real test? During the April tax season, because I guess a lot of people will buy it, since if I remember right, the subscription fee is only $100. So I think a lot of people will probably buy it. If people buy it and find out, hey, it actually works, then the traditional software companies are going to have a real headache. But if it doesn't work, well, then nothing's changed yet. So making a definitive judgment right now, I have to say, it's just too early, way too early. So will these software companies take a major hit? I think they will. I think it's entirely possible. So for these software companies, the question is whether they themselves can also launch something that belongs to them based on their own business experience and their own data to create an even better AI model. Or maybe, some related tools that can improve overall efficiency. But to be honest, even if they manage to develop something like that, it's not necessarily a good thing for these companies. I'm not kidding. I'm being serious. It's not entirely a good thing because once they really pull it off, then it all becomes a matter for the public. The value of the company's own core employees would be replaced. Maybe from the company's operations perspective, their costs might go down, but if you look at it from the labor market's point of view, for example, a consulting firm, like a tax consulting firm, what could happen in the end is that originally they might have needed 100 people, but in the end, just 10 people could run the entire company and serve all their existing clients. So for the company, this might be a good thing, but for the employees, it's not entirely positive. As for these existing software companies, can they actually make this kind of transition? There are actually a lot of office politics behind this, a lot of human factors, and issues related to corporate governance, ESG, or corporate responsibility. So whether this transformation can really happen, honestly, none of us know. That's why we need to keep observing. So will this lead the entire software industry to become a faith-based industry? I think it will. The strong will become even stronger. Those that can survive and make it through will become even stronger companies, while those that can't will naturally be eliminated. So I don't necessarily think it's the software or the industry itself that's becoming faith-based, but rather that some companies are just facing structural experiments, if you think of each company as a person. Some people will inevitably face structural unemployment and eventually be eliminated by the market. Actually, I think this is a fact that will always happen with every technological revolution. So this is just something for everyone to keep in mind. So if you want to ask which software companies are worth buying and which ones aren't, I have to say, from my current perspective and from my personal point of view, I would lean toward recommending that you just stay away from these kinds of companies. So what I've been talking about with everyone this week basically are not these types of companies. I suggest that everyone should focus on more core consumer assets or companies involved in reindustrialization, because when it comes to the impact of AI, these companies are basically unaffected. AI really can't impact them. Can AI have any impact on Chevron? What I mean is, can AI really impact Chevron? Can AI replace Chevron's drilling rigs and go out to extract oil? Can it replace Chevron's existing business operations and somehow magically create a bunch of new ones? Like asphalt and then a bunch of chemical products and raw materials? I just can't do that. I can't produce these things, so it's impossible for these companies to be challenged or replaced by AI. That's why I'm now leaning toward recommending this direction, because the market is likely to agree more with this logic and perspective. It's heading toward a new all-time high, but it's currently in a consolidation phase as we await a breakout. Fortunately, X3's LNG project in the US has been quite successful, so their natural gas extraction should also go pretty smoothly. And then their production in the Permian Basin and Guyana is also going smoothly, and both are above the cost line. What does 100,000 barrels mean? Well, it means that every 100,000 barrels above the cost line is pure profit. All of it is net profit. Now, in the short term, a relatively bearish factor is that Venezuela is actually not very willing to get involved. Actually, overall, its situation is similar to Chevron's. It's also gradually improving, but compared to Chevron, it's already hitting new highs. The reason it's reaching new highs is because its decline wasn't as severe. The degree of decline wasn't that serious. And actually, yesterday, it maintained its investment. Yeah, and it keeps making money. Its cash flow is also continuing to grow. So fundamentally, it's pretty good too. Its price to book ratio is 2.4, which is relatively low. But if you're more of a value investor, personally, I might lean more towards recommending Chevron. If you care more about momentum, then I would recommend Exxon over Chevron. If you consider the momentum factor in your investment decisions, then ExxonMobil might be a direction you're willing to invest in, because its momentum's actually relatively strong. So it really just keeps hitting new highs. It really just keeps reaching new highs. Next is Schlumberger. Schlumberger is mainly focused on producing related equipment, refining equipment, and drilling equipment. So it's considered a more upstream arsenal. For the oil industry, it's basically the arsenal, the supplier of related equipment. It's trending up long term with no obvious decline. After a slight dip in 2025, it's risen steadily since 2021. 2024 and 2025 look like consolidation years, but after 2026, everything rises. EPS, revenue, and cash flow all keep climbing. So basically, for equipment manufacturers, their future operations are looking better and better, which means someone is investing. And why would someone invest? Because there's profit to be made. So in other words, the long-term trend for the oil industry might be upward. It might be upward, so from the perspective of equipment, we really do see this opportunity. Right now, its DPE and its EPS are both steadily rebounding, so there's a chance for a Davis double play with SLB. This stock actually seems to have the potential for a Davis double play, and its PE ratio is only 17 times, which is actually lower than the market average. So relatively speaking, the chances for it to catch up or experience a Davis double play are actually quite high. It's forming a right side rebound and might start rising directly. It could even trend upward right away. And then Harry Burton, he writes HL, and it's basically the same logic. So this is also something for everyone to consider. For now, I mainly wanted to show you these four companies. And if you have more faith in Buffett and Berkshire, then maybe you might want to consider using Oxy. It could be a stock worth paying special attention to, because at the very least, the price you're buying at now should be cheaper than what Buffett paid. So if you want a simple strategy, it's just to buy at a lower price than Buffett. When Buffett starts selling, you just follow along and buy too. If you think that's enough for your strategy, then that's it. All right, moving on. Oh, right. Hey, so when you say several years, are you referring to oil or something else? I'm not too sure. I'm not too sure about this downturn, because if you're talking about the oil industry, I think it might not stay down for several years. It might not stay down. It's possible it could start rising this year. It could start rising this year, even though just now, whether it was Racal or Bernstein, they both seem to say 2027 or 2028. But the stock price will reflect it ahead of time. And it's even possible if this year, for all sorts of reasons, maybe some unexpected geopolitical reason causes oil prices to react early, then the market will respond in advance, just like that. So in a way, that's why I'm recommending this page. I'm starting to talk about energy here because actually this year it's already started moving. It's already in motion this year. And based on the usual momentum in the US stock market, sometimes what moves early can end up leading for the whole year. It's possible that it could stay strong for the whole year. So here, I actually think there's a high chance it's starting to rise from the right side, or at least making a right side recovery. As for whether it can set new highs, that will depend on whether its fundamentals can keep up, but I think it will keep moving upward. I think the probability of an upward trend is relatively high. As for the euro, PHG is fluctuating at a high level, and European stocks probably have a chance to keep climbing higher within the next week or two. As for Germany, roughly speaking, actually, I don't think it's likely for German bonds to surge significantly. It's just not likely in the short term because there's quite a large amount of German bonds being issued. Ugh, software stocks. When it comes to software stocks, you really need to be selective. I recommend picking specific stocks rather than just buying any software stock you see. I wouldn't suggest doing that. And since you're already considering whether to hold on for a few years, personally, I'd actually suggest that if you're already taking a loss, say you're down by 10, 18, or even 28%, I'd recommend just cutting your losses and moving on. When the market sentiment is good and there's a rebound and you have a chance to reduce your losses, just go ahead and sell. Sell and switch your investment into something you or we think has better potential. My personal suggestion is to move towards stocks with industrial attributes. Oh, so who's looking strong in pre-market trading right now? At the moment, Cloudflare is performing pretty well in pre-market. As you can see, Cloudflare is basically an AI software company. It's also software related and it's doing really well. So it's really not the case that every software company is weak. Not every company is weak. So when it comes to software, if you want to look at stocks, you need to be selective. You can't just see that it's software or that it has AI and then just buy in. You really need to do a deep analysis of it. So to some extent, it's not a direction where you can easily make money at any time. Instead, it means you'll have to do a lot more homework. All right, then, about Trump trying to push down oil prices, I have to say that's pretty tough. Honestly, it's really difficult because demand isn't actually that weak. Demand really isn't that weak. And if Trump does push down oil prices, shale oil producers would be wiped out. Let me put it this way, if prices keep dropping, going below 60, down to the 50s, it would be a disaster for them. Shale oil producers would all be wiped out, and basically, shale oil is a major financial backer for the Republican Party. Traditional oil is also an important supporter. If you keep pushing prices down like this, you're basically dealing a heavy blow to the Republican Party's main donors and their financial base. There's a lot of talk about suppressing oil prices, about wanting to bring oil prices down, but to be honest, since he took office in 2024 or 2025, over the past year, oil prices, strictly speaking, haven't actually dropped significantly. They went down for a bit, but then came back up. So will Trump really suppress oil prices? For example, on this issue, I have to put a question mark for now. I honestly need to put a question mark here. All right, moving on. Everyone can keep practicing as usual, but when it comes to interest rates, the probability of them really dropping significantly is still pretty low, still quite low. US stocks are sideways at high levels, and the NASDAQ is likewise. The same goes for the NASDAQ and also the Dow Jones. Looking at the Dow Jones's closing price, actually, the Dow closed yesterday at a record high at one point during the day. And today, the market sentiment is pretty good, so it basically closed at a new all-time high again. So if you prefer index investing, personally, I'd recommend using the S&P 500 or the Dow Jones as your reference. Then someone asked about real estate, specifically US real estate. Over there, prices are indeed rising right now. As for real estate stocks, there's an interesting situation. They tend to move in line with policy changes. So when it comes to real estate stocks, I think you really have to look at each one individually. Let me first share my immediate thoughts. For example, right now, I can't give you a complete response right away, but if you follow the logic I've been talking about this time, basically, in the past, I personally have preferred asset-heavy companies, companies that are more asset-oriented, or those that are more production-oriented, meaning their production attributes are stronger and their service attributes aren't as significant. Also, their valuations aren't excessively high. So I think maybe there's still a pretty good chance for them to perform well, because like in the past few years, this area has indeed. Real estate stocks have actually performed relatively well too, relatively well. It's just that the four types I talked about earlier are even stronger this time, which is why I focused on them. As for real estate, personally, I still feel that it's kind of like when these four rise, everything else gets lifted along with them. And then for real estate, it's probably also starting to be more about stock picking. So it's more about choosing the right stocks. As for the Taiwan stock market, maybe we talk about it during our morning call, since this good night session is mainly about the US market, so it's not really appropriate for me to go into detail about Taiwan stocks here. That's all for today's Good Night with Master Kuan Ying. Thank you all for watching, and I wish you all smooth trading. See you tomorrow. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.